U.S. equities have sold off and are retesting their June lows. We are in a bear market. But for longer-term investors, bear markets do spell opportunity, as it is a relatively rare occurrence and have historically been a great opportunity to pick up stocks on the cheap. That is our bias. We want to take advantage of this market downturn and add some risk. But that raises the question of which assets and when do we buy them? Right now, the question of which assets is probably the easier of the two. We have done a lot of work on market cycles to help determine how different asset classes have historically performed in each stage. Looking forward, ultimately, we want to start to position in those asset classes that tend to perform well in the next stage, the early cycle. Historically, small and mid-cap stocks have led the market out of a downturn, and often that outperformance extends into the mid-cycle. But do valuations allow us the ability to start positioning into those asset classes? Currently, small and mid-caps are very cheap on a PE basis, both absolute and relative to large caps. This chart looks at historical PEs for the S&P size indexes. Note how they are near all-time lows and selling at a discount to large caps. Still, small and mid-cap companies do tend to be more economically sensitive, and the economy is slowing, so we do see earnings risk. But the lower valuation suggests that we are being better compensated for that risk. So we are biased in that direction. But we will also want to eventually get to an overall equity overweight versus fixed income. Currently, we're sitting at a neutral strategic weight. This brings in the question of when. And it is the more difficult question, as it implies market timing. Unfortunately, market timing is much more a function of luck than it is skill. So recognizing that we won't be able to perfectly time the bottom, how do we approach it? We are looking for a confluence of things. One is valuation, and for large caps, unfortunately, we are not close to past bear market lows. Another factor is whether we're seeing more realistic investor expectations. Certainly, a recession is becoming most investors' base case, and that is good, but it has yet to feed into earnings expectations. Bottom-up analyst estimates suggest continued earnings growth, yet our EPS model suggests a decline. And then another factor relates to market sentiment. Generally, the time to buy is when it is emotionally the most difficult. And here again, we don't think we've gotten there, but we might be getting close. The Fed has moved so fast and so aggressively that we have yet to see that economic damage that it may have caused. But in the coming months, we expect to see more evidence of some real economic stress, and at the same time, the Fed is likely to remain steadfast. That combination should create some significant investor discomfort. One other consideration is the importance of being fully invested before the bull market gets started. Our historical work on bull markets suggests that the early cycle typically captures 41% of the total bull market return. Certainly, we could wait for more definitive signals like the Fed shifting to an easing mode, but our market cycle analysis suggests we would rather be early than late. For more of our thoughts on U.S. equities, please visit our website at touchstonefunds.com.
This commentary is for informational purposes only and should not be used or construed as an offer to sell, a solicitation of an offer to buy, or recommendation to buy, sell, or hold any security. Investing in an index is not possible. Investing involves risk, including the possible loss of principal and fluctuation of value. Past performance is no guarantee of future results. Please consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. The prospectus and the summary prospectus contain this and other information about the funds. To obtain a prospectus or a summary prospectus, contact your financial professional or download and/or request one at touchstoneinvestments.com/literature-center or call Touchstone at 800-638-8194. Please read the prospectus and/or summary prospectus carefully before investing. Touchstone funds are distributed by Touchstone Securities, Inc., a registered broker-dealer and member, FINRA, SIPC. Touchstone is a member of Western Southern Financial Group. Copyright 2022, Touchstone Securities, Inc.